Okay, so let's look at buying a call option and buying a call vertical side by side to really drive this point home as to why we would do a vertical over just buying a call option. So let's do what we would have done back in the day, which is we might have bought the 1250 call, and in this case that would have cost us $5,625. And why would anybody do this? Well, they do it for one reason only, which is this undefined profit potential. But we've already learned when we buy call options, if we can win more than we can lose, which is the case here, on average our POP is only 35%, and it holds true here. So we're paying quite a bit of money, right? Over $5,000, $5,625 for the chance to make a big win, but our POP is super low. Let's go to buying a call vertical instead and see why that might be a better option. In this case, as we saw, we bought the 1250 call and we sold the 1260 call. And what does that mean? It means the width of our strikes is $10, which means the entire size of this trade, if you add profits and losses together, has to equal $1,000. So this vertical cost us $490, which means, as we've learned, the most we can make is $510. So we're defining our profit here, right? Here it's undefined, here it's defined. Why do we do that, right? Don't we like these lottery tickets? No, we don't, because our POP is so low. By defining our profit in this case, you can see down here our POP has gone all the way up to 48%. It was 35, now it's gone all the way up to 48%. And the most we can lose on this trade is only $490, where in this case, we can lose over $5,600. So our loss potential is much lower, right? We've defined our loss as well to a much smaller amount. But by defining our profit, we've raised our POP way up from 35 all the way to 48. Much better. And that is why we define profit, because by defining profit with the vertical, we raise our POP way up from just buying a call option by itself. And it allows us to play these bigger stocks. This $1,200 stock, if you want to play this game, look, one option is going to cost you well over $5,000, right? Who can afford to play that game, especially with this POP so low? In this case, we're playing the same game, but we get to play it for a small percentage of that amount. We're only spending $490 is the most we can ever lose in this trade if things go horribly wrong. And we can make $510, but our POP is way up here now as opposed to way down here. That is why we buy call verticals as opposed to buying call options outright. Again, defining our profit raises our POP way above just buying an option by itself.